everyone. A very good afternoon to everyone. I hope you all are fine and doing well. Let me check first the voice that everything is okay. Okay. So let's start with the class. And what we are going to do today, CAIIB PYP, like some questions, some topics which already are there in the previous cycles. So we are just discuss some questions related to our BFM examination. So let's start with the class. I am discussing here some of the questions. Now what you have to do, you have to see every question, read every question, and then you have to answer in the comment section. Here we are revising the concepts which are already important for our examination, right? So we prepared some questions just for practice. With this you will get the overview, like these types of questions will be there in the examination, right? So let's start with the class. Allow me a minute only. Okay. So the first question is there in front of your screen. Mr. Saqib, an Indian citizen, resides in Dubai and does not qualify as a tax resident in the UAE or any other country. During financial year 2024 to 2025, his income as follows: 12 lakh from rental property in India, 5 lakh from interest on NRI deposits in India, 25 lakh from consultancy services that is rendered outside India for a business controlled and managed entirely from the India. Based on section 6 subsection 1A of the Income Tax Act, determine Saqib's residential status and scope of taxable income in the India. So I'm sharing the options. These are the options. First option is saying non-resident taxable only on 12 lakh rental income. Residential and resident and ordinary resident taxable on 12 lakh rental plus 25 lakh consultancy income plus global income. Resident but not ordinary resident taxable on 12 lakh rental plus 25 lakh consultancy income. Deemed resident but treated as non-resident taxable only on Indian sourced income 12 lakh rental. So here are the options. I am sharing the main question. Okay, this is the main question. Let me hide myself so you can read carefully. Now, how can you answer this question? See, for answer, you can also type your answers in the comment. See, this is basically, if we see this Mr. Saqib, he is an Indian citizen who is living in Dubai. Rental income is 12 lakh. Rental income, rental property in India. So 12 lakh is the rental income. 5 lakh is there from interest, that is exempt. This is exempt under section 10 subsection 4 second, right? 25 lakh is there, but this business is controlled in India. So first check the normal residential rule. Normal residential rule are under section 6 subsection 1, right? Now, here, what we have to do, next thing is, we have to check the residential rule. Now, basic condition is there, 182 days stays in India or 60 days plus 365 days in the last 4 years. So, Saqib stays abroad or he fails both. So, he is not a resident under the normal conditions. So, here we have to apply deemed resident provision of section 6 subsection 1A. And a person is a deemed resident when he is an Indian citizen. Saqib is the Indian citizen. His taxable income is under 15 lakh in financial year. His taxable Indian income is equals to rental 12 lakh plus NRE 12 lakh only, which is obviously less than 15 lakh. So he does not qualify under income threshold. But we also check he is not liable to tax in any other country. Since Dubai UAE has no personal income tax, so Saqib is not liable to tax anywhere. So here, what we can say, for subsection 1A, the 15 lakh limit refers to income from Indian sources, not global. His Indian income 12 lakh rental, which is less than 15 lakh. So technically, he escapes deemed residence test here. He does not falling into the deemed residence one. But here, one more concept is there in the option RNOR. Resident but not ordinarily resident. In this, whatever the income earned received in India, taxable. 12 lakh rental is taxable. Foreign income from the business controlled from India, taxable. 25 lakh. Purely foreign income, not taxable. So taxable income is this 12 lakh plus 25 lakh, which is equals to 37 lakh. Right? Now, final answer I can say that residential status, deemed resident, RNOR. Taxable income, 12 lakh plus 25 lakh. NRE interest, he is exempt. So the correct option is here, option C. Right? Correct option is option C, resident but not ordinary resident, taxable on 12 lakh rental, 25 lakh consultancy income. Right? So this is the case study on the NRI. So I hope that it is clear now which income is taxable or which income is not taxable. Right? Now, next question. The question is on modified duration. A 5-year bond with a face value of 1000 offers a 10% annual coupon paid semi-annually. The bond is priced at par rupees 1000. The yield to maturity is also 10%, that is analyzed. So give this information. Calculate the modified duration of the bond. So first let's discuss what is the meaning of modified duration. What is modified duration? If I say modified duration follows the concept the interest rate and bond prices moves in opposite directions. There is a formula which is used to determine the effect that a 100 basis point 1% change in interest rate will have on the price of a bond. So modified duration measures the change in the value of a bond in response to a 100 basis point in interest rates. Modified duration is an extension of the Macaulay duration And to calculate modified duration, the Macaulay duration must first be calculated. Macaulay duration calculates the weighted average time before a bond holder receives the bond cash flows. As a bond maturity increases, its duration increases. And as a bond coupon and interest rate increases, its duration decreases. So what is the formula of the modified duration? That is, modified duration is equals to Macaulay duration divided by 1 plus YTM, yield to maturity, and this yield to maturity is divided by N. Right? Now, what is the meaning of Macaulay duration? That is the weighted average to the maturity of the cash flows from a bond. YTM is a yield to maturity, and N is number of coupon periods per year. Now, how to solve this question? Simple. We have given here the Macaulay's duration. First, we have to calculate the Macaulay's duration. How? See, since the bond is at par and coupon rate is equals to yield to maturity, its Macaulay duration will be slightly less than the maturity, that is 5 years. If we use the duration table or summation, we get that it is 4.33. Then it is divided by 1 plus yield to maturity is here 10%. So we have to take 0.10 and it should be divided by 2. Then it is equals to 4.33 divided by 1 plus 0.05. That is equals to, when we solve it, we get here, it is equals to 4.12 years. Or one other way, how can we solve this particular question? See, we know the formula, right? We have the formula. Now, if we need to solve this question with another way, how can we solve? First, we all having the bond value, everything is there. So simple. Here, face value, we know that 1000, right? And annual value of coupon, we have 10% of 1000, which is 100 rupees, right? Semi-annual means 100 by 2, which is equals to 50. Maturity is there 5 year. So semi-annual yield to maturity is equals to 10% divided by 2, which is equals to 0.05, or you can write it as 5%. Right? Now we have to calculate the present value here. Right? So when I calculate the present value, so simple, cash flows are rupees 50 for the first 9 periods, then rupees 50 for coupon, plus 1000 rupees is there as a principal for a period of 10. Then present value of coupon payment is 50 multiply 1 minus 1.05 minus 9 divide by 0.05. That is equals to rupees 355.17. So present value of principal. What is the present value of principal there? Rupees 1000 multiply 1.05 power minus 10, that is equals to 613.91. When we add these two, we got here 969.08. Then after this, we have to calculate the present value for each cash flow, and then you can apply the formula of the modified duration. Then you will get the answer 4.52 years. That means option C is correct there, right? Now the next question. Under the Basel Third Framework, which is implemented in India, the capital conservation buffer is designed to enhance the resilience of bank by mandating an additional capital layer during the periods of normal growth. So, which of the following statement most accurately reflects the regulatory design and intent of the CCB in the India? So let's first discuss the CCB is a concept that is introduced under the new international Basel norms. The concept says that during the good times, banks have to build up a capital buffer that can be drawn from where there is a stress. In India, the minimum capital requirement is 9%. And CCB would be 2.5% points over and above the minimum capital requirement. So why it is important? In simple words, this is the savings for the future, as this capital can be drawn when a bank is incurring the losses. Since it is a buffer and extra capital, bank's minimum capital is not violated. And CCB is being implemented in a phased manner of 0.625% per year from the January 1st, 2016. Final phase is delayed by over a year till March 31st, 2020. And why we need this CCB is introduced? See, when the crises are there of 2008, CCB concept gained attention. When large banks witnessed their capital is decreasing at a fast phase. So CCB was aimed to cover off their losses on the risky investment. And Basel Committee on Banking Supervision realized that its capital buffer norms, wherein two kinds of structures were introduced. One, the CCB, and the other was counter-cyclical capital buffers, and RBI decided to implement both. So here what we can say, according to the question, CCB here is a phased in capital buffer, cumulatively reaching 2.5 over and above the 9% minimum capital requirement. It is designed to absorb losses during stress without reaching regulatory minima, which phased implementation beginning January 2016 at 0.625% increment. So now, I hope that this question is clear. Now the voice is clear. Kindly tell me. Thank you for telling me. Let me check first. I hope that it is clear now. So now, I hope that this question is clear. Thank you. So the next question. Mr. Arjun, an Indian citizen working in London, comes to India for a family visit during financial year 2024 to 2025. His details are: he is staying in India during financial year 2025 to 24 to 25, 140 days. Stays in India during preceding 4 financial year is 380 days. Indian income excluding foreign sources is 18 lakh. So what will be his residential status for financial year 2024 to 25 under the Income Tax Act 1961? So, how to solve this question? First, we have to do here, we have to check which condition is applied here. And here, he stays in India during the financial year of 2024 to 5, 140 days. So normally 182 days, he 182 days required, but he stays only 140 days. So obviously he fails here. Second, we can say 365 days in the past 4 year plus 60 or 120 days in the current year. So past 4 financial year 380 days, so okay, and current 140 days, it is also okay. So he qualifies as resident. Now since his income is 18 lakh, which is greater than 15 lakh, so he is a resident. He is returning Indian and not satisfying long term residency condition. He will be classified as RNOR, treated like NRI for the foreign income. So here we can say the correct answer is RNOR. And if I give you the overview of NRI, who are the NRI? A person in India, if they do not satisfy conditions. Which conditions? Stay in India for less than 182 days in financial year, or stays less than 365 days in last 4 years, plus 60 or 120 days in the current year, in the current financial year. So NRIs are only taxed on the income that is earned, received in India, and foreign income is not taxed in India, right? Same, ROR is resident and ordinary resident. These basically a person is ROR when he qualify or he or she qualify as a resident. They have been resident in India at least 2 out of the last 10 years. They have stayed in India for at least 730 days or more in the last 7 years. So ROR are taxed on global income, both Indian income and foreign income. Same, option D is a deemed resident. Deemed resident is basically a resident who is an Indian citizen. Their income is less than 15 lakh, or they are not liable to tax in any other country. Such persons are deemed residents of India, but they are always RNOR, never ROR. So like RNOR, these are taxed on Indian income, foreign income from the businesses who are managed from the India. So the answer is, in this case study, the correct answer is resident but not ordinary resident. So which of the following statement most precisely captures the interplay of regulatory authorities, procedural requisites and statutory exceptions governing India's export regime under FEMA as articulated through RBI and DGFT mandate. Now I hope you can see the full question. See, if I give you the overview, this DGFT, Directorate General of Foreign Trade, sits under the Ministry of Commerce and Industry. Same, if I talk about the here, DGFT frames and implements the EXIM and foreign trade policy, also issues the IEC, importer exporter code, which is the basic license like identifier to do import export. RBI here administers foreign exchange under the FEMA, keeps forex reserves, and also frame exchange control directions, circulars, and finances export trade through the banking system. So authorized dealers who are permitted by the RBI, they handles the receipts, payments, and export documents on the RBI behalf, whereas export declaration form, there is two important form. Softex form is just for the software, and there is a EDF form which is for all the things that are not related to softwares are not included in this. So I can say that in the in this question, option B, if we read the option B is saying the RBI is the custodian of foreign exchange reserve. RBI is responsible for taking care of foreign exchange reserve, overseas exchange control, and finances export trade, while the DGFT, operating under the Ministry of Commerce, allocates IEC under the FEMA norms, export declaration forms with statutory relaxations. So here we can say that the correct option is option B. So the question is only saying that what are the work of the DGFT? What is the work of the DGFT under the RBI? The question is there on put option. Consider a European style put option written on a stock currently trading at rupees 120 with a strike price of rupees 130, expiring in 30 days. So assume risk-free interest is negligible. Which of the following statement accurately reflects the valuation dynamics of its option as it approaches the maturity? So here, if I give you the overview of the put option, what is put option? Put option which gives the holder the right to sell, and which provides the holder the right to buy the underlying security, and the predetermined price is called the strike price, right? And if we see the question here, there is an intrinsic value of a put option. Strike price is given 130, spot is 120 here. So obviously the difference of these two is called the price, that is intrinsic value, that is rupees 10. So expiry is here still 30 days away. So the option has extra value due to volatility, right? So what we can say here the option possesses intrinsic value of rupees 10 and positive value component. As time to expiry reduces, total option premium coverage toward intrinsic value provided volatility does not spike abnormally. So this option is perfect for this question. We got intrinsic value, the difference of spot and strike price. So the correct answer is there, option A. Now the stock is trading at rupees 200. You buy the put option with a strike price of 210. What does it mean? What does it mean? See, what is a call option basically? Call options are the financial contracts that give holder the right but not the obligation to uh, buy any particular asset at a predetermined price, right? Here, if we see, the spot price is given, stock is trading at rupees 200. So we can say that here the put options give the holder the right, which is sell at the strike price. So here, if the stock falls to rupees 150, right, if the stock falls at rupees 150, you can still sell at rupees 210. Options are the right, not obligation. So you don't have to sell if it is not beneficial. So which option is correct here? I think A option is correct. A stock trading at rupees 200 and the put option with the strike price is 210. So you have the right to sell the stock at 210. So the correct answer is option A. I know the complexity of the question is little bit higher here, like some difficult language and some difficult questions, because IIBF is giving the hard questions, so we have to make sure that we know the hard questions here. So the next question is there. An investor purchases European call option on a stock with a strike price of rupees 500 by paying a premium of rupees 40. At expiry, the stock closes at rupees 560. Which statement most accurately represents the investor's payoff profile? See, here I can say that the correct answer is, I already told you about the call options. These are the financial contract that give holder the right but not the obligation. So here spot price is given 560, right? Strike is given rupees 500. So intrinsic value is rupees 60. So net profit is intrinsic minus premium, that is equals to 60 minus 40 rupees 20. So here what we can say, which option is correct? You can see the option is exercised. Intrinsic value is rupees 60, but after deducting the premium, the net profit equals 20 rupees per share. So don't need to read any other option because option A is correct here. Clear? Now investor B owns 100 shares of Gamon India. Each currently trading at rupees 100. To generate additional income, B sell one call option with a strike price of 120 at a premium of 0.40 per share. So which is the following most accurately that describes the here B payoff situation at the expiry? How to solve this question? See, here stock price is less than the strike price, right? So call will not exercised. Option expires. B keep the shares plus 40 rupees premium. Case 2 is there. Stock is greater than strike. Call here exercised. B have to sell shares at rupees 120. Through the market is rupees 130. So you can see the loss of 10 rupees here, right? But this is offset by 40 rupees premium. Net loss is here 960. How? See, here if I say in the case 1, we have to see every case. So first let's discuss about the case 1. In this you can see stock is less than the strike and call is not exercised. Option expires. B keep the shares, 40 rupees premium as profit. Case 2 is there where stock is greater than the strike. Call here exercised. B have to sell shares at rupees 120. Through market is rupees 130. So you can see 10 rupees loss is there, and 10 rupees into 100 share is equals to 1000 rupees, but it is offset by 40 rupees premium. So net loss is there 960. So here general rule for covered call is max profit in this is equals to premium, which is 40 rupees. If stock remains here, that is less than or equal to the strike price. So here potential loss is unlimited, as the option is saying. B have to still sell at 120. So here every case is correct. Option A, option B, option C, option D. All of the statements are correct. Just a minute. Next question. As per the RBI guideline, a loan classified as SMA2 indicates special mention accounts according to the RBI guidelines. I hope this one is easy. SMA accounts are the special mention accounts, and up to 30 days are classified as 0. Up to 30 days to 60 days, these are come under the SMA 1, and for more than 60 days to 90 days, these are SMA 2, right? So here 10th answer is option C, that is 61 to 90 days, high risk of turning NPA. Which of the following statement regarding special mention account classification is most accurate? So here we have to read the question. we have to read every option here. So read the option. I think the correct answer here, if we read the option, you can see the first option, SMA framework applies only to large corporate with exposures above 500 crore. So this is not correct. SMA 0 is flagged when dues are overdue between 1 and 30 days. SMA 1 31 and 60 days. SMA 2 between 61 and 90 days, which the account become an NPA. So I think this option is perfectly correct. So which of the following most accurately reflects the evaluation of the standard for document examination under the UCP, culminating in UCP Article 14 of UCP 600? Article 14 of UCP 600 gives the rules for how banks have to check the documents which are prepared under LC. These rules are supported by ISBP 745, which explains standard banking practice. So UCP 82, here bank have to check document carefully to see if they look correct. UCP 222, which added the phrase, there is a phrase on their face, where document have to look at the first sight. UCP 290, which add the idea of inconsistency. UCP 400 is there, which introduce the wording that later become UCP 600 Article 14 subsection F. So UCP 600, which sets the universal rules, and ISBP 745, it is a guide to explain how to apply the rules. So I can say there the correct answer is in this UCP 222 was the first to introduce on their face as a standard for examination. So the correct answer is D option. So we have to discuss 100 questions. This is our part 1. Let's see how many questions we can discuss in this one part, right? UCP 600 Article 14 was supplemented by ISBP 745. So which of the statement is most correct regarding the nature of rules versus practices? I know today is a weekend. 25 questions we can learn today. 20 to 25 questions. Then we can continue this in another part. So how can we solve this? What is the statement here? See, UCP rules are universally binding unless the credit explicitly states otherwise. Means ISBP 745, they are not rules but guidance on the best practice, interpretation and application of UCP standards. They here basically in this thing we can say UCP are universally binding and ISBP provides interpretative guidance that may be contested depending on the context. One more case study. ABC Bank is a mid-sized retail banking operating in India. Bank primarily earns income from the loans, home loan, corporate lending, while paying interest on consumer deposits. Like most banks, Its profitability is measured partly through its NIM. Average earning assets are given. Interest income from loan investment is given. Interest paid on deposit and borrowings are given. So, how to calculate the NIM here? I think we have to apply the formula of the NIM, interest income minus interest expense divided by average earning assets. So this 1200 crore minus 800 crore divided by 10,000 crore, right? And for percentage we can multiply it by 100. Now what is the answer here? 4%. 4% is the correct answer here, right? So the answer is 4%. This is our income. This is our income, and we have to reduce the expenses from it. Simple NIM formula. And NIM question is there in the form of case study. Next question is on NII. XYZ bank has the following financial details. We have to calculate the NII. We have to tell that the other two questions also. So let's first calculate the NII. And how to calculate the NII? What is the formula of the NII? NII formula, basically NII is the difference between the revenue generated from a bank, assets and expenses that is incurred while paying its interest bearing liabilities. So for the calculation of the NIM, how can we calculate the NIM? Interest income minus interest expense, right? So here 5,000 minus 3,200 crore, that is equals to how much? 1,800 crore. This is the NII of the bank, right? This is the NII of the bank. And now NII will, what is the NII if the interest rises by 10%? Then we have to calculate 3,200. Then we have to calculate the 10% of this. So I think this will become 3,200 multiply 10%. This is 320. So 320 plus 3,200 crore, that is equals to 3,520 crore. This is the new NII, right? Now new NII, we have to calculate the new NII. That will be equal to 5,000 crore minus 3,520, which is equals to 1,480 crore, right? 1,480 crore if the interest expenses rises by the 10%. Then this, in this case, our NII is 1,480 crore. And the question is saying now that third part is saying, rated on the above, analyze how interest rate impacts the bank profitability. So it is simple. Bank profitability is basically original NII is 1,800 crore, new NII is 1,480 crore. So there is a loss of 320 crore. So 380 crore rising interest rate, bank increases the bank cost of deposits, borrowings, which reduces their net interest income. Unless loan rates are increased accordingly, profitability will shrink. Right? So, in the context of export bill discounting, which of the following best explains the role of exporters' financial intermediary? Export bill discounting, what is this? It is a post shipment finance option, right? Post shipment finance option where a bank provides an exporter with early payment against unpaid export bills. Typically it is backed up by a letter of credit or open account terms by purchasing the bills and charging a fee. The exporter's financial intermediary ensures quick payment to the exporter once shipping custom departments are furnished, and later recover funds from the buyer bank. It is not dependent on the buyer resale of goods, does not directly finance the buyers, and role is broader than just currency exchange. So here, which option is correct? It facilitates early payment to the exporter upon proof of shipment while assuming the responsibility of collecting funds later from the buyer's bank. So, which of the following reflects a key advantage of export bill discounting for exporters in the international trade? I think main advantage is faster working capital turnover because exporters does not want to wait for buyer's payment. They get paid after shipment. Proof and documentation is still required. Forex protection is added but not core benefit, and buyer credit is not eliminated entirely. So if we see the correct option here, which option is correct? I think option B is correct here. So which of the following best explains the binding nature of UCP 600 in international trade? UCBDC, which is Uniform Custom and Practice for Documentary Credit. It is a set of standardized rules which is developed by ICC governing the issuance and use of letters of credit in international trade. UCP 600 provides a framework for managing trade transactions, reducing any type of discrepancies, and ensuring consistency among banks and commercial parties which involve in global commerce. So here we can say UCP 600 only applies when a letter of credit expressly states that it's subject to UCP 600, but once incorporated, its rules are binding unless specifically modified or excluded. In the context of UCP 600 and documentary credit, which of the following statement is most accurate? So let's read. UCP 600 replaces the need of examining trade documents since compliance is assumed when a credit is issued. This is incorrect. UCP 600 establishes uniform rules for handling letter of credit but allows flexibility for banks and applicants to modify specific provisions in the credit terms. Obviously, they establishes the uniform rules. UCP 600 guarantees payment to exporter regardless of whether the document presented conforms strictly to the credit terms. This is not correct. UCP 600 is enforced by national courts directly. Incorrect. Only the correct statement is option B, where UCP 600 is there establishes uniform rules for handling letter of credit, also allows flexibility for banks and applicants to modify specific provisions in the credit terms. So under the LRS of the RBI, which of the following is not permitted for a remittance by a resident individual? LRS to remit funds abroad, but remittance of for margin trading, lottery winning, speculative purpose, this is completely prohibited. Right? Ravi, who is an Indian resident, wants to remit money under LRS scheme. He already remitted 1,50,000 for his daughter tuition fees. Now he wants to remit 1,20,000 to buy property in Canada. So which of the following statement is correct? We know that under the LRS the limit is 2,50,000 in a financial year, right? So under the LRS the aggregate limit is US dollar 2,50,000. Ravi already used 1,50,000. See, he can only remit 1 lakh more in this particular financial year. So here we can say the correct answer is Ravi can only remit US dollar 1 lakh, since the total annual limit under LRS is US dollar 2,50,000. Under Basel II Accord, which of the following statement about capital adequacy requirement is most correct? I think according to this Basel II Accord, subordinated debt term which cannot exceed 50% of tier 1 capital, right? In the tier 2 cannot exceed tier 1. Tier 3 is only to cover the market risk, not operational risk. And asset revaluation reserves, they must only discount by 55%. So the correct option is there, option C, subordinated debt is limited to a maximum of 50% of tier 1 capital. Which of the following best illustrates the difference between Basel I and Basel II framework? Difference between Basel I and Basel II. See, Basel I focused on credit risk. Basel II include market risk and operational risk. Basel I only focus on credit risk, but Basel II introduced market risk, operational risk under the pillar 1. This is the main difference. So option B is correct here. Which of the following is not a primary aim of Basel III framework? Basel III framework. I think Basel III introduced stricter capital requirement, which include CCB and leverage ratio, not eliminated them. It aims at better stock absorption, stronger risk governance, and improved transparency and disclosures. So here the correct answer is according to the option to completely eliminate the requirement of maintaining a capital conservation buffer. An investor notices RBI increases the repo rate 6.25 to 6.50. So how many basis point has the repo rate increased? What is basis point? It is a unit of measure which is used to indicate percentage changes in financial instrument. Basis points are typically expressed with the abbreviations like BP, BPS, BIPS, and one basis point is equal to 1/100th of 1%. So here we can say there is a change of 0.25%. So 0.25% is equals to 25 basis points. So the correct answer is option B, 25 basis points. So these are the questions for today. We will discuss all the questions in the upcoming sessions. I hope that it helps. The questions are easy or moderate, I included. So please do the comment in the comment box, and any problem is there, you can ask there. So thank you so much. Let's meet in our next class. Till then, take care and have a good day all. Thank you.